everyone, and welcome to the Vancouver Resource Investment Conference YouTube channel. And we are blessed today to be joined by Lobo Tiggre from the Independent Speculator. Always good to see you, Lobo.
Good to see you too, Jesse.
So let's begin by talking about central bank gold buying, because I saw you were recently posting about this on Twitter. Reserves are currently at levels not seen in 48 years. So why do you think the central banks are buying so much gold? And is this a good sign for gold prices moving forward? Is this a catalyst or a tailwind in your mind?
Well, the second one's easier to answer. So I would say clearly yes. I mean, if you remember, not too long ago, we had a central bank gold agreement, which limited the central banks to not selling more than 500 tons a year. Only central banks would think of gold in terms of tons. It's priced in ounces, and it's a ridiculous number, as Doug Casey likes to point out. But that's government for you. For having central banks turn from net sellers to net buyers is big. For them to be buying at record numbers, clearly that can't hurt. Supply and demand does matter. So it's a good thing. How long will it go? What does it all mean? This is the sort of stuff that, lends itself to conspiracy theories and just plain old theories, plain vanilla theories. And honestly, I think the most useful thing I can say here is just because some theory makes sense to you, that doesn't make it true. And not to rain on the parade here, but my job is not to be a cheerleader for gold bugs. Yay, gold, yay. My job is to help people make money. And if you talk yourself into believing some theory, like as soon as Basel III goes into effect, the central banks are going to remonetize gold. That's why they've been buying. It was a great theory. It seemed to fit the facts. It made lots of sense. But guess what? A year almost since Basel III went on, and no big flip-flop from the central banks. And so if you were betting the farm on that changing everything, say last January, or the previous deadline midsummer the year before, or the previous Basel III deadline before, you know what I'm saying, right? That's risky. So do I have a theory? I don't know. I suspect that they probably don't care as much about gold as we'd like to think they do, but they're not stupid. And if the balloon goes up, the pin pricks the bubble, whatever you want to call it for the metaphor, everybody could use a little insurance, even central banks. So I think as a minimum, that's a reasonable supposition. As far as these bigger theories, you know what? They may be true. Some of them, they can't all be true. Your theory might be true. I just think it's very dangerous to bet the farm on some wild theory, especially one that comes with a deadline. On January 31st, gold's going to the moon, right?
Absolutely agree with you there. I would like to pivot to China and what's going on there with their COVID zero policy, because we are starting to see announcement that things are easing up. When it comes to the CCP, much like the Fed, I think it's about watching what they do and not what they say, because there's just so much propaganda coming out of that country, and a lot of it could be to save face, so to speak. But how do you see that all playing out? Obviously, we don't have a crystal ball, but do you think China's actually moving towards reopening? And if they do, how will that impact the commodity space?
I think at this point, there's no question they're moving towards reopening. A week or two ago, I think there was a question. There were rumors, there were things that some officials said, maybe walked back. Nothing really changed. But now, I mean, it's happening. And reports from many sources and official statements about changing the rules, making them more targeted initially, but now large-scale rollbacks, like not having to show a negative COVID test for internal travel within China, anywhere within China. That's huge. I mean, these are big rollbacks of the zero COVID policy. Of course, without saying so, there's not a lot of face saving that can happen here. I think ignore it, try to sweep it under the rug is as close as they're going to get. But here's the interesting thing, and I got to tell you honestly, Jesse and dear audience, I'm scratching my head a bit on this, because the market reaction to just the rumors that this might be starting was very substantial. I mean, big market moves. And the reaction to it actually happening is kind of muted. Now you can say, oh, well, buy the rumor, sell the news. But that's not what we're seeing. It's not like they bought something and they're selling it now. It's more like go crazy about the rumor and go meh about the actual news. That's not making entire sense to me. So I'm watching it. I think maybe one of the caveats here is that as this is happening, a lot of the people that they're interviewing in China and so on are saying, well, but I'm really scared. You know, I don't have to show a passport to travel, but I don't want to leave my apartment, that sort of thing. You know, you lock the country down for 2, 3 years, and that's going to have a psychological impact. So what if they open up the regulations and the people just stay home? You know, winter is coming. Literally, it's a northern hemisphere country, so they're going into flu season. So it might be that we don't actually see the full impact of what's going to happen here until next spring. Now, that was actually my expectation. This has moved faster than I thought it would. I thought that they would have to roll things back eventually, not because of the protests, but just because of economic reality. You know, the slashing of output over there that's not sustainable. So it's happening faster than I expected. The markets are reacting weirder than I expected. I'm not sure how useful I am going to be here, but at the end of the day, I do think reality matters. China doesn't want to go from being the second largest economy in the world to the third or fourth. It wants to be the first. So I think ultimately this is very bullish for commodities. I think, will it be enough to swamp the global recession that's coming and shaping up? I can't promise that, Jesse. I don't know. But it is a force for the plus. If we have this other force for the negative, this is a force for the plus. I think we see the effects next spring, and we're just to see how big they are and how much they help for commodities and the global economy as a whole.
I'd like to get your take on copper here because I know you've said in the recent past that you're kind of sitting on the sidelines when it comes to the base metals, potentially expecting a recession and a potential further price drop. We're hearing more and more about copper shortages up ahead. Have you changed your view on that, or do you still think there could be more downside to come?
I absolutely think there can be more downside to come. You know, I'm not one for wild, bold predictions. The market's going to crash tomorrow, next week, something like that. But my experience is 100% that when something happens like this, we go into recession, or there's some economic bad news that's going from potential theory maybe to, you know, imminent reality. That's always bad for commodities prices, including copper. And a shortage doesn't matter. You know, there have been times where copper has stayed years below the cost of production. That's obviously not sustainable. It doesn't help the price. You know, the fact that we're looking at massive shortages, and you know, it's not just me saying that, it's not just the company CEOs, though there are plenty of the big ones, and yes, they're talking their book, but they would know. You know, it's their business to know the copper market. To have these biggest players in the field saying, starting in a year or two, we're looking at severe copper shortages, and independent firms, you know, the Woodmacks of the world, that sort of thing. So the chorus of credible sources is really very strong on this. Not disputing that at all. I'm extremely bullish. I've described copper as the sort of thing that, you know, if you can handle the volatility, you could buy a great copper stock now, stick it in a drawer, and come back in 10 years, and you'll probably be fine. Has to be a great one. But that doesn't mean it won't go lower first. That's what I'm saying. My experience is 100% that something like this recession that we're looking at, which they're still in denial about, you know, we're still hearing soft landing is possible from some central bankers. We're still hearing mild and short from most of the talking heads on financial media, even though they're saying it's coming. And I don't think either of those scenarios is realistic. And as that awful reality sets in, it's going to whack copper, even with those deficit realities staring them farther in the face. I think copper gets hurt first, and I think that of all industrial metals. I haven't sold any of my copper stocks, by the way. I think mine have survivability. I'm happy with them. I'm just not buying anymore because I think the odds favor me being able to buy new ones or average down on the ones I have at better prices in the months ahead.
What are your thoughts on battery metals as we sit here today? Lithium, graphite, cobalt. Maybe we can focus on lithium just for simplicity's sake. It seems a huge part of the bull case revolves around a certain portion of the population switching over to electric vehicles, the EV revolution, etc. It feels to me like that is not going to happen in the time frame that the political class, in all their wisdom, has dictated that it's going to happen. So, what is your feeling on lithium, for example? Do you think it's going to continue its upward trajectory, or when the dreams of the world driving EVs, if and when they fall apart, nobody knows the future, do you think that could affect prices?
Well, I've actually got my team digging into lithium, and we have been for some months, and it turns out to be considerably more complicated than anybody might think. It's not just because of lithium hydroxide versus carbonate and the switching back and forth and so on, but there's very little agreement between the different experts and the companies themselves on some of these basics. But let me address the big question first, because on the one hand, we're seeing more and more legislative mandates, right? You know, you're going to have all electric in California by 2035 or whatever it is, in New York and Europe places. On the other hand, there's visibly no way that everybody can have an electric car and be able to charge it in California now, and in 2035 is not that far away. So on the one hand, I get it. I understand the pushback and saying, well, gee, all this EV brouhaha, it's overdone. The prices have got ahead of themselves. You know, they're going to tank. It's the last part I'm not so sure about, because yes, I do think it's overdone. Yes, I think at some point reality matters. And sort of like with Europe right now, realizing the difficulties that they've got themselves into shutting down their nuclear power plants. At some point, reality matters as 2035 approaches, or 2030 in some cases, and there just aren't enough charging stations and all that, you know, that will affect things. But I think people who just don't like the ESG mandate want to believe that story, that it's all going to blow up and we're all going to go back to driving gas cars. But that's not going to happen either. And the adoption is happening faster than the skeptics have said. So yes, everybody driving a Tesla in 2030, that's not going to happen. Everybody going back to gas cars, that's not going to happen either. And the rate of adoption it has been consistently higher year after year than the skeptics have. You know, it hasn't been the wild Tesla dreams, but it has been higher than people have thought. So I don't think that extra EV demand is going away. For minerals that really need it, you know, particularly the cobalt for the current chemistry, I think that's worrisome, because, and we don't want to get too deep in the weeds here, but if that cools off, it's not like there's a bunch of other cobalt demand that's going to step in instead. Whereas your nickel, your copper, even your lithium, you know, that goes into a lot of other products too. Lithium may be more vulnerable, but like copper and nickel, those are industrial metals with huge demand anyway. This is kind of complicated. I don't know how far we want to get into this, Jesse, but basically, I guess my comment would be buyer beware. You can't just run out and buy all battery metals because you believe in the EV promise. And you shouldn't dump them all just because you're an EV skeptic. You should look at each one. Just as an example, we have a free report on our website right now about nickel, which I think, you know, after the went vertical, you know, $100,000 a ton earlier this year, or, you know, people are excited, but the reality is that there's a lot of nickel out there. So, you know, buyer beware.
Very level-headed. That's why we love talking to you. The truth normally lies somewhere in the middle. I think that's how you generally view things. So I know you're going to be at the Vancouver Resource Investment Conference, January 29th and 30th. For everybody out there, it's free to attend, and there's a ticket link in the description below. So what are you planning to present, or what can we expect from you at this year's VRIC?
Well, clearly January is a great time to look forward for the year. The specific things I'm going to be keying in on are, one, how this China reopening plays out. And by then we should have a lot more data, very telling data. This, you know, China consumes 50 to 60% of most of the metals we love and care about in the world. It's the biggest gold producer. They don't export any. Right? So this can't be, oh, it can be overstated, but it is vastly important what happens with China. So I'll be looking at the trends there. The other one that I'm really keeping my eye on is the fate of what I call the wrong trousers. And that's the DXY dollar index. For some crazy reason, even though for the last 50 years, gold prices, gold and silver exchange rates versus the dollar have primarily been driven by real interest rates because they're money. Over the last year, they've been very much corresponding on a daily basis to the DXY. And I just think that's the wrong measure for a host of reasons we won't get into, but just at some point, I think there's a wake-up call, but probably not right away. And this matters because I think the dollar is due for a reversal. I think that the Fed led the way into tightening. I think the Fed is going to lead the way into easing, rightly or wrongly. I think the odds favor the European Union continuing to have more inflation and therefore be seen as the more hawkish central bank. And this should all be playing out by January. So, even if interest rates are lower in Europe than the US, if it's perceived that, the banks are moving in different directions, right? The ECB is tighter and the Fed is easier, then that should whack the DXY, that should boost gold and silver and all commodities in general, but particularly the monetary metals. So as we meet in Vancouver, and I do encourage people to come there because I can answer your questions in person. I think it's a fantastic time at these conferences. But as we're there, these, I think, will be the key things that will be determining how I place my chips for the months and the year ahead.
Well, thank you so much for joining us today. For those who want to hear more from you, could you tell us about the Independent Speculator and anywhere else you'd like to direct people online?
Well, thank you very much. The Independent Speculator is my, prime newsletter, but I understand that that's a big thing for people to jump in who don't know me or don't know my track record. So we have a free digest called The Speculator's Digest, goes out once a week. If you sign up for that, you can see how I think, see what I do, see if I make sense to you. And I promise we won't spam you with a flood of daily advertisements if you do. It's free.
Great. Well, yeah, I'll put a link in the description below so people can find that and look forward to seeing you at the VRIC.
Thank you, Jesse. You too.
We actually need to have a damn good recession.
The Russian economy is a gas station run by the mafia.
$41 trillion has been created out of nothing.
There's a stranglehold in China on most of these resources.
The outlook and fundamentals for the metals remains very, very strong.